Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. China's economy has entered one of its most important transitions in decades. While headline GDP growth remains relatively stable, the forces driving that growth have changed dramatically. The property sector that once powered the world's second largest economy continues to weaken, while advanced manufacturing, technology, and exports have taken over as the primary engines of expansion. This transformation is creating a far more uneven economy, with some sectors accelerating while others continue to struggle. In today's report, we'll examine the data behind this structural shift, assess where policy is headed, and explain why understanding the composition of China's growth has become far more important than simply looking at the headline GDP number. We begin with government financing, which offers an important clue about the direction of fiscal policy. This chart compares the progress of government debt issuance across recent years. At first glance, 2026 appears broadly similar to previous cycles, with financing moving steadily through the first quarter. However, there is a notable difference beneath the surface. Unlike previous stimulus episodes, where borrowing was quickly translated into aggressive infrastructure spending, policymakers are now taking a far more measured approach. Debt issuance remains relatively front-loaded, but spending has become increasingly selective. This reflects Beijing's changing priorities. Rather than maximizing short-term growth through another massive construction boom, policymakers are attempting to balance economic stabilization with financial sustainability. Years of accumulated local government debt have significantly reduced the room for another all-out infrastructure stimulus. In other words, the government still possesses fiscal firepower, but it is choosing to deploy it with much greater precision than in previous downturns. The next chart illustrates perhaps the most important structural transformation taking place inside China's investment landscape. Over the past decade, manufacturing has steadily expanded its share of total fixed asset investment, while real estate development has experienced a persistent decline. Infrastructure investment has remained relatively stable, and other categories have changed little. This shift tells us that China's growth model is no longer centered around housing construction. Instead, capital is increasingly flowing toward advanced manufacturing, industrial upgrading, and strategic technologies. The economy is effectively being rebuilt from within. Rather than relying on apartment construction to generate growth, policymakers are encouraging investment into semiconductors, electric vehicles, automation, renewable energy, and high-end equipment manufacturing. This reallocation of capital will likely define China's economic trajectory for years to come. Infrastructure has traditionally been Beijing's preferred countercyclical policy tool. Whenever growth slowed, infrastructure spending usually accelerated sharply. This chart shows that the relationship has changed. Broad infrastructure investment has moderated considerably, with transportation and public utility projects moving largely in line with overall infrastructure growth rather than significantly outperforming. The slowdown reflects tighter fiscal discipline rather than an absence of available funding. Local governments are now operating under much stricter borrowing constraints, forcing policymakers to prioritize projects with stronger long-term economic returns. Instead of building infrastructure simply to boost GDP, Beijing increasingly wants every yuan invested to improve productivity and support strategic development. That marks a fundamental change in China's policy philosophy. Looking across the three major investment engines, the picture becomes even clearer. Manufacturing investment, infrastructure investment, and real estate investment are all slowing, but they are slowing for very different reasons. Real estate remains the weakest segment, with investment contracting more than 16% year over year. Manufacturing investment has also moderated after several years of exceptionally rapid expansion, while infrastructure growth has eased as fiscal policy becomes more targeted. This does not necessarily signal an imminent recession. Instead, it reflects an economy entering a more mature phase where policymakers are prioritizing efficiency over sheer investment volume. One important policy initiative supporting this transition is Beijing's campaign against excessive industrial competition, commonly referred to as anti-involution. Rather than encouraging endless capacity expansion, authorities are increasingly focused on improving profitability and reducing overcapacity across key industries. Consumption remains one of the weakest areas of China's recovery. This chart highlights a growing divergence between services and goods consumption. While service sector spending has remained relatively resilient, retail sales of goods continue to weaken, dragging down overall consumption growth. Several structural factors explain this imbalance. Households remain cautious because property prices have yet to fully stabilize, income growth has slowed, and consumer confidence remains subdued. Services such as travel, entertainment, and restaurants require less financial commitment than purchasing automobiles, appliances, or new homes. As a result, consumers continue to prioritize experiences over large discretionary purchases. Until household confidence improves more meaningfully, consumption is unlikely to become the primary engine of China's economic expansion. Demographics represent one of China's longest-term structural challenges. The country's population has now declined for 4 consecutive years, with the largest annual decline occurring most recently. Births continue to trend lower despite multiple government efforts to encourage higher fertility. Demographic changes unfold slowly, but their economic consequences accumulate over decades. A shrinking working-age population limits labor force growth, reduces long-term housing demand, and places increasing pressure on public finances as the population ages. Unlike cyclical economic slowdowns, demographic trends cannot be reversed through short-term stimulus. They require broad structural reforms and considerable time. For investors, this means China's future growth will increasingly depend on productivity improvements rather than labor force, thus expansion. Despite these structural headwinds, headline GDP growth has remained surprisingly resilient. Our forecast projects China's economy expanding approximately 4.7% in 2026, slightly below the previous 2 years, but still comfortably within the government's broader target range. Importantly, the composition of growth matters far more than the headline number itself. Unlike previous recoveries driven by construction and housing, today's expansion relies increasingly on exports, technology investment, and advanced manufacturing. Growth may be slower than in the past, but it is becoming more concentrated in sectors that policymakers view as strategically important for China's long-term competitiveness. Quarterly GDP illustrates this transition even more clearly. After moderating through the middle of the year, we expect growth to stabilize around the mid 4% range during the remaining quarters of 2026. This relatively stable trajectory reflects several offsetting forces. Exports remain supportive, industrial production continues to outperform expectations, and targeted fiscal policies should prevent a sharp slowdown. At the same time, weak domestic demand, cautious consumers, property market adjustment, and demographic pressures continue to limit upside potential. Rather than experiencing either a hard landing or a powerful stimulus-driven rebound, China appears increasingly likely to deliver a prolonged period of moderate but stable growth. One of the defining characteristics of China's post-pandemic economy is the widening gap between production and consumption. Industrial value added continues to outperform retail sales by a considerable margin. This divergence reflects China's growing reliance on manufacturing exports and industrial upgrading rather than domestic consumption. Global demand for products linked to artificial intelligence, semiconductors, advanced machinery, batteries, and electric vehicles continues to support industrial output even as domestic spending remains relatively subdued. The result is a distinctly K-shaped economy where export-oriented industries continue to expand while domestically focused sectors face much greater challenges. The divergence becomes even more striking within manufacturing itself. High-tech manufacturing has accelerated significantly faster than overall industrial production. This reflects massive investment in artificial intelligence infrastructure, semiconductor production, advanced electronics, automation equipment, and renewable energy technologies. China remains deeply integrated into global technology supply chains, despite ongoing geopolitical competition. Rather than competing primarily on low-cost manufacturing, the country is steadily moving up the value chain toward higher margin, more technologically sophisticated industries. This transition will likely remain one of the defining investment themes throughout the remainder of the decade. The divergence becomes even more striking within manufacturing itself. High-tech manufacturing has accelerated significantly faster than overall industrial production. This reflects massive investment in artificial intelligence infrastructure, semiconductor production, advanced electronics, automation equipment, and renewable energy technologies. China remains deeply integrated into global technology supply chains despite ongoing geopolitical competition. Rather than competing primarily on low-cost manufacturing, the country is steadily moving up the value chain toward higher margin, more technologically sophisticated industries. This transition will likely remain one of the defining investment themes throughout the remainder of the decade. An especially symbolic milestone appears in this chart. For the first time, information technology's share of GDP has essentially caught up with and even marginally surpassed the real estate industry. This represents far more than a statistical crossover. It demonstrates how China's economic structure is evolving away from construction-led growth toward innovation-driven development. Technology now occupies a central role in industrial policy, investment allocation, and long-term competitiveness. The transition will not happen overnight, but the direction has become increasingly unmistakable. Housing activity also reveals a highly uneven recovery across regions. Tier 1 cities continue to outperform smaller cities in new home sales, while lower tier markets remain considerably weaker. This reflects stronger labor markets, better demographics, and tighter housing supply in China's largest metropolitan areas. Policy support has helped improve transaction volumes in major cities, but excess inventory remains elevated across much of the country. As a result, any nationwide housing recovery is likely to remain gradual and geographically uneven rather than broad-based. Inventory data reinforces that conclusion. Housing inventory remains historically elevated, particularly in lower-tier cities, where supply continues to exceed underlying demand. Although inventories have begun to stabilize in certain regions, the adjustment process remains incomplete. Reducing excess supply will require both time and sustained improvement in underlying demand. Until inventories return to more normal levels, developers are likely to remain cautious, limiting new construction activity and reducing the property's contribution to overall economic growth. Finally, we return to fiscal policy. Government revenue growth remains volatile due to weak land sales, subdued corporate profits in some sectors, and the lingering effects of the property downturn. Meanwhile, government expenditure has remained relatively stable as authorities continue providing targeted support to strategic priorities. This divergence illustrates the balancing act facing policymakers. They must simultaneously support growth, manage local government debt, encourage industrial upgrading, and maintain financial stability. Rather than pursuing another large-scale stimulus campaign, Beijing appears increasingly committed to a gradual, disciplined approach focused on long-term structural transformation rather than short-term economic acceleration. China's economy is no longer defined by a single growth engine. Instead, it is undergoing one of the largest structural reallocations of capital in modern economic history. Property continues to decline. Consumption remains subdued. Demographics present long-term challenges. Yet advanced manufacturing, high technology, exports, and strategic industrial policy continue to generate resilience. For investors, the key question is no longer simply how fast China grows. It is where that growth comes from. Understanding that distinction will be essential as China's economy continues its transition toward a new development model. Thank you for watching YCC Capital Macro Research. If you found this analysis valuable, please subscribe for more data-driven insights into the global economy and financial markets.